Hi, Lacey here for Money School, and I'm here today to talk to you about the finance industry's fees and commissions and how they affect you, your financial life, and the decisions that you can make. And the reason why I decided I wanted to talk about this is I attended a PNC meeting a couple of weeks ago, and there was a bank at that meeting, and they were offering the school, if the school was willing to endorse them and exclusively promote their bank, that they would get a percentage back for every home loan that the members of the school took out. And the way that that worked was like, someone comes in and say, I'm from so-and-so school. Oh, great, here's our rate, which may or may not be a special rate. Most of the time it's just whatever the rate they've got that's going. And depending on the value of that loan would depend on how much the school got, but the explanation they gave was that about $3 million worth of loans, so that's maybe 10 loans at $300,000 each, would result in about $6,000 coming back to the school. So it's big bickies, right? And that's basically how banking and finance works. If you promote my product or you recommend my product to your client or something like that, then I will give you a cut of what they're going to spend. And it's the same everywhere, right? Like, banking is not the first place that this happened. All sorts of sales do this, but those commissions are what gives people incentive to recommend a particular product or a particular brand. And, for example, let's take mortgage brokers. A mortgage broker, when they connect you to the bank and you sign up and you pay the loan, they get something called a trailing commission. So for the life of the time that you're paying that loan back, they get money. And that's the bank's way of saying thank you for recommending our product. Now, this is just a normal practice in finance. Okay, that's just how it works. It's the same as, school banking, where they pay a commission for the number of children that sign up, or a life insurer that will pay a commission to the insurance broker that recommends them. It's everywhere in finance. It's just how the finance industry runs. Now, the problem with that is it introduces a risk, right? So if you get paid a certain amount of money for recommending a product, then the incentive is there to recommend that product, even if it might not be the best fit for your customer. Now, of course, the finance industry has very strict regulations on this, and people are obligated to disclose what they're getting paid from those companies, and they are obligated to disclose any conflict of interest. So they have to tell you. However, we know this doesn't work, right? That we still get people getting bad financial advice. So if you think back to last year's banking scandals and the very crappy inquiry that they went through, which didn't result in much change, we have people that have lost homes because they took bad financial advice. And part of that is because of how the people who gave the advice get paid. So that's why I'm really hot on this topic of you need to understand how the people giving you advice or selling you products are getting paid, and you need to ask. You have to ask. It's your obligation. Now, I've spoken to plenty of financial planners who will go, no, I do the right thing for my clients. I get the same commission. It doesn't matter which bank or which product I recommend. So I make sure I do the right thing by them. There's all these checks and balances in place. Now, that's fine. And there are many, many financial planners out there that do the right thing, and advisors as well. However, what I learned from my time in engineering and working in mining is about risk is applicable here. And what I guess to give you a bit of background, I'm a chemical engineer, and I worked in mining for about 10 years. And in that first 5 years, I was very heavily involved in risks. I learned about process hazard analysis for major hazard facilities. I did workplace risk assessment and control, hazard and operability studies. I'm a trained facilitator in all of those. So very heavily involved in that. And that we're talking about with mining and the processing plants that I worked at, places that kill people, right? Like hundreds and thousands can die if things go wrong. So they're very stringent. But they talk about one thing in all risk assessment and control, which is called the hierarchy of control. And this is, okay, I've got a risk. How am I going to prevent it from actually happening? How do I stop people from dying or things exploding or that kind of stuff? So, and I've printed it out for you here. This is the hierarchy of control. So see, it starts at the top with elimination, substitution, engineering, administrative, behaviour. You can see this is American version, and PPE. So just to explain that, elimination is I get rid of the risk entirely. So, if I'm supposed to work at heights, I find a way to make the work happen on the ground level. They're, no risk, you can't fall. Substitution is I find another way to do it. Engineering is about like barriers, like I make it hard for something to go wrong, like safety valves and things like that. And then you've got the administrative stuff, which is paperwork. And then you've got behaviour, relying on human beings to make good decisions and training them to do the right thing. And then PPE, which is personal protective equipment. It's like I'm going to wear a gas mask, that kind of stuff. Now, elimination is by far the most preferable because you just get rid of the risk. It's not there anymore, okay? So we're all trained when we do this sort of stuff to make sure that we can eliminate it if we can. Now, when it comes to finance, there is a way to eliminate this risk, and that is not to work with anyone who takes a commission. Straightforward, right? If they don't take a commission, then they can't have this thing happen. Now, when you study this stuff, and I've done it at quite a high level in deep statistics, just because that's what you get to do when you're an engineer on a processing plant. And the interesting thing about human behaviour, which is we rely on administrative controls and human behaviour in the finance industry. That's what we think is going to make the difference for people so that they don't get screwed over or given bad advice. We rely on people that have been trained and so they adhere to a code. And we rely on paperwork, basically saying you shan't do this, and you sign something that says you're not going to do it, and you disclose stuff. That's how we go. So it's actually pretty far down the hierarchy of controls. It's not very strong. It doesn't work very well. And we know that whenever you calculate risk, if you've got to rely on human behaviour, if there's any point where it relies on a human decision, you have to assume 100% of the time they will get it wrong. Isn't that fascinating? So if you've got something that says, oh, well, it's about the decision of the individual, every calculation I do which says, okay, well, the individual has to decide, probability says they will get it wrong. 100%. I can't even put like 80% of the time they're going to get it right. It is, you have to assume with this stuff, if you're relying on a person, they will get it wrong because we're humans. We do. We make mistakes. We have self-interest. Emotions are important. So that, I think, is pretty fascinating in this case. And that's why I talk about if you can eliminate commissions from the advice you're getting, then you've eliminated that potential. If you're relying on human behaviour and administrative controls, then some people are going to lose. They're going to get given bad advice and sold them bad products, you know, and unfortunately, we've seen it happen. And it's not just on commissions, it's on fees as well. So if I think back to the Bell Potter case that was publicised last December, so mid-December 2016, it was on 7:30 report, that was a case where a company just kept moving the investments around a lot so they could get a fee every time the thing went in and out. Out of $1 million portfolio, they got $200,000 in fees. So you can't tell me that that wasn't an incentive to do that, because it definitely wasn't a good financial decision for the people they were representing. But out of that $1 million, they got 200 grand because they kept chopping and changing the investment. Now, that's what I mean about this stuff. It doesn't matter how good your administrative controls are. It doesn't matter how good your training is. Someone eventually is going to get given bad advice, and someone eventually is going to make a bad choice. It's just how it happens, and you have to assume that when you do any risk calculation. And I guess that's the difference between the finance industry and processing is that, and mining, is that people die very easily in mining and in processing, and so you have to eliminate those risks. In finance, we don't see it as such a big deal. We just say, oh well, administrative controls are enough. And behaviour's enough. And the fact is, people die. They get depressed because they lose everything and they kill themselves, or they end up homeless. It is that big a deal, and it is that important. So when you are going to take financial advice or buy a financial product, here are the ways that you can eliminate that risk. First of all, you need to ask if people are receiving commissions or how they charge their fees, and you need to be really clear on this. How much are they getting? How long for? And you need to be confident that they're giving you the right product, and that's up to you, okay? You need to be doing the cross-checks. Now, a lot of people will say, well, what about industrial reform? And I would love to see the industry banish commissions. It would be fabulous. But the fact is, we're probably going to have to wait a long time to do that, because politicians are not going to want to do it. To be blunt, it would not win them any votes or any support from the business community. So we have to take it for ourselves, I think. I think we've just got to accept that the quickest way to get there is that we make a good decision. So next time you're thinking about finance, think about this hierarchy of control. Can you eliminate the risk of getting screwed over? And that's really the thing that you need to do. Be aware of commissions and fees, find out who's paying you what. Thanks for listening to my rant. Hope you enjoyed it. Looking forward to your comments. Cheers. Bye.